from the Global Council for the Promotion of International Trade welcomes you all for this exciting webinar on unlocking working capital efficiency throughout effective treasury management. If you are a founder, CFO, or business leader seeking to maximize your working capital potential, then do join us for an insightful webinar hosted by the Confederation of India Micro, Small and Medium Enterprises. This event is designed to empower you with the knowledge, strategies needed to optimize your financial resources. Before we begin, I would like to introduce myself. I am Alinya Banerjee Chatterjee, the R&D and Communication Officer for GCPIT and your host for the evening. And I would like to call our first speaker, Mr. Anshul Sharan, co-founder and CEO of Elver Investment Advisor Private Limited. Welcome, Mr. Sharan, and over to you.
Thank you, Anya. Thanks a lot for this invite, for getting this session. So let me quickly, and thanks Santosh definitely for arranging this webinar. So before we jump onto the presentation, let me just quickly quick brief about Elver and also about us. So first of all, welcome everyone. Talking about Elver, Elver is a SEBI registered investment advisor, and we are into the business of providing investment advisory solutions to both retail as well as corporate clients. Specifically for the corporate, we basically help in doing the treasury advisory, where we help manage their cash more effectively, which will in turn help in improving their longevity of their working capital, which can have a lot of positive impacts in terms of reducing their loans or reducing less capital, or getting better return, things like that. So multiple things are there. So we'll discuss more about it during the session. But before that, let me just talk about me, and then I'll pass on to Karan, who can brief himself. So I come with almost 16 plus years experience in the financial services. Primarily worked on the investing as well as on the lending side, on the micro lending side. I have worked in the prior experience. I was with Credit Access Grameen, which is one of the largest microfinance institution in the country, and I was handling strategy for the first 6 years, and then I was chief risk officer. As part of strategy, I also did the IPO of the company in 2018 and did various fundraising as well as product launches for them. And prior to that, I was part of an investment firm where I was building passive products like indices for global ETFs now. In terms of education, I have done my engineering from IIT Bombay. I'm also an MBA from IIM Indore. I'm also an NSIM certified investment advisor. That's a bit about me. I'll hand over to Karan to introduce himself, and then he can walk through the presentation.
Thanks, Anshul. Thanks, Ananya. Thanks, Santosh. Welcome, everyone. This is Karan. I'm Chief Investment Officer and co-founder with Elver Investment Advisor. I have overall 12 years of experience in investment space, and most of my experience goes into designing passive strategies for ETFs, mutual funds, and pension funds. Okay, so I've worked for 10 years exclusively in passive space. Okay, and the strategies, passive strategies that I designed were licensed to fund managers based in US, UK, Australia, and South Korea. And overall, so by the time I left my last organization, nearly $10 billion were tracking on the strategies, tracking the strategies that were designed by me. Okay, I hold an MBA in finance from Management Development Institute, Gurgaon, and I'm a CFA chartered. That's about me. Anshul, you want to kick off the PPT? I'm sharing it. Yeah.
You can start. That's good enough.
Thank you, Mr. Karan, and thank you, Mr. Sharan. And would request one of you to start with the PPT.
Sure.
Okay, so here we are talking about how treasury management can unlock working capital efficiency. Okay, so here in PPT, we are focusing on short-term treasury. Okay. So short-term treasury can be in different forms. It can be receipt of sale proceeds that you have just closed a sale and you receive the sale receipt, revenue receipts, and you are using that as a working capital you are going to use that as a working capital for next 1 to 3 months. It can be like funds which are available with MSME entity that they've outlined that they've basically you can say earmark for next 1 year, that they will be using it for business expansion, setting up a new factory, and gradually they will be releasing it as and when they are needed. Apart from this, in last 3-4 years, there's a new form of treasury also come into play where VC and angel funds have funded the startup. They've provided them with the capital, okay, basically to set up the business, kind of a bridge financing, zero interest bridge financing, and basically there's it's supposed to support operations for next 12-18 months, okay, and till the time company become basically reach from pre-revenue stage, transition from pre-revenue stage to revenue stage. So there can be more form of short-term treasury as we go. Okay, these are the top. These are 3 things that we typically focus on. So typically, when you are deploying short-term treasury, you are looking at different options. The most common option is, as you have a bank relationship, most of money is sitting in current account. So easiest option typically people go for is 15-day and 30-day fixed deposits. The good thing about these short-term fixed depositors, there's zero liquidity risk. You will get your money back in 20-30 days and you can revolve it again and again into FDs till you finally put it in business. Okay. And also if you need money in the between, you can also get an overdraft facility from the bank. But the problem is the returns that you earn on working capital are quite low. It goes down to around 2.5 to 3.5%. Normally, banks offer 3% on these short-term FDs. Okay. The second option for deploying short-term treasury is it has been quite popular in the past. Sweep in, sweep out FDs from current account. Okay. So there is no restriction on liquidity. You can withdraw whenever you want to withdraw. Okay, from the FD. It's a flexible that way. Okay, but the problem is whenever you withdraw the remaining amount, the lower balance that is remaining, basically the remaining part of the FD would attract a much lower interest rate than you agreed with the bank, that you negotiated with the bank, and it will remain so till you top up it again to the original balance. Okay, that's quite common problem with sweep out FD. So that's why, despite offering returns that goes up to around 4.5%, effective returns come out to be around 3.54% only. That's a common problem that is faced by MSMEs in deploying short-term treasury in these traditional FD options. Okay, so here there's one more solution that is there. Typically till now most of big corporates are actually already using these options. Okay, that is called treasury management. So in treasury management, what these corporates typically do, they invest their short-term treasury in a portfolio of debt mutual funds and bonds. Okay, mostly they go for AAA rated bonds. Okay, they're basically free from the risk. Okay, credit risk. And these portfolios are supposed to provide annualized return to 7 to 8%. That's the mean expectation. Okay, for 7 to 8% per annum. The returns are on annualized basis. Okay, and there the best thing is there is zero liquidity risk. Okay, so if you want to, let's say you have a sudden emergency and you need money from the portfolio and you want to liquidate the portfolio, there are zero exit charges. Okay, there are no exit charges, there's no penalty, you can take out the money. And if you do proper duration matching, okay, principal risk is also zero. So as you can see, there are 3 steps that we have provided. So let's just consider an example where you have let's say 12 crore of treasury you receive a funding of 12 crore and you are supposed to use it, let's say you want to use 2 crore in next 15 days. Okay, after 1 month you want to use 4 crore, you want to withdraw 4 crore, then you need another 2 crore after 4 months, and then another 3 crore after 6 months. So that's why you have an expectation on when you would need that money that is there. When would be your cash outflows? Okay, so what you do based on your requirement, cash requirement and liquidity requirement, and what is the risk threshold that you want to use to cover for emergencies, you can create a portfolio, okay, where there is zero liquidity risk and there is zero principal loss risk. Okay, even if there are interest rate movements are there, RBI increase the rates, you can minimize your principal loss risk to zero if you make the portfolio through duration matching. Okay, and as you can see, there are certain advantages these treasury portfolios offer over FDs. Okay, so treasury portfolio typically offers 7 to 8% of return, while FDs it's around, as we already discussed, 3.5 to 4.5%. So liquidity risk with FDs is quite high. Okay, even if there's a overdraft facility, but it has a cost attached to it. In case of treasury portfolio, your liquidity risk is practically zero. Okay, for principal risk in FD is zero. When you are there, promise you return of 4% and you stay through the term. Say, let's say you go through the agreement fully, you go through the term. So you will definitely receive that return. Okay, 4, 4.5, 3.5, whatever it is, you will definitely get it. There is no doubt about it. Treasury portfolio, these instruments trade in the market, so it's difficult to promise exactly that you will get 7.5 or 7.6 or 8%. Okay, but usually if you do proper duration matching, I will explain the concept later on in the PPT, the principal risk can be reduced to zero. Okay, so credit risk with FDs, if you are doing in high credit banks like SBI, ICICI, even the HDFC, so generally credit risk is zero. If you go to NBFCs and smaller banks, credit risk increase. You get better rate on FDs, that's there, but credit risk also increase. In treasury portfolio, typically if you restrict your exposure to AAA rated debt instruments, okay, your credit risk is zero. Okay, loan against holdings, overdraft is available against FDs. Okay, similarly against mutual fund holdings as well, loans facilities available. Okay, so there both are at equal footing. Okay, so as we can see on risk side, we are basic treasury portfolio is almost similar to FD, tad bit better on certain aspects actually, while return potential is almost 100% higher. So here we have provided some case. Basically, we are trying to here show you what is the delta, what are the excess returns that you can earn if you go for treasury portfolio instead of FD. Okay, so here we have given an example of a company which has received a funding of 12 crore and which will be taking out 1 crore every month. Okay, to fund its operations. Okay, and so if you, as you can see, over the 12 months treasury portfolio, if you invest these 12 crore in treasury portfolio but keep withdrawing 1 crore every month, you will your returns additional money that you will make on your investments would amount to around 51 lakhs. Okay, while in case of FD, it will amount to around 30 lakhs. Okay, so there is an additional 20 lakh that you would be making on your investment in this case. Okay, so we have provided one other case study as well. So here we are basically assuming that there is a company which is receiving 1 crore of sales receipt every month. Sorry, every month they are getting the sales realization is 1 crore. Okay, and company use entire balance by month end. They are paying to after 20 days they need to buy raw materials. End of month they have to pay the salaries to their employees. Okay, rental lease they need to pay, different expenditures. These 1 crore will take care of it. Okay, and then at the end of the month the entire amount will be practically used, and in the beginning of month they will again receive sales. They will again have a sales realization of 1 crore, and cycle continues. So in this case we have shown that if the amount was invested every month at the beginning of the month, this 1 crore invested in treasury portfolio, okay, over the course of the year, you will make, so the company would have made 7,76,000 rupees. Okay, and in case of in the FD investments, it would be around 4.6 lakhs. So there are additional 3 lakhs that the company would have made had they gone for treasury portfolio. So having shown that treasury portfolio actually can create significant delta for companies over their short-term treasury. Okay, we need to understand there are some ground rules that need to be followed around when you're investing in bonds and debt mutual funds. Okay, this treasury portfolio. Okay, so we have to remember that this is a short-term treasury. This is the money that is needed for business. This is not exactly the money to build wealth. Okay, this is the to make the to build basically invest in business, and in the side you can make some additional money that can give you some cushion. Okay, in case of some emergency, some cash shortfall, some additional money is there. Okay, so risk management is the most important aspect in treasury management. Okay, uh, rather than going after returns, the first priority is the risk. You have to take care of the risk, and the second step is the return. Okay, so I'm just be doing some basic introduction of some terminology around bonds and debt MFs. Okay, that need to be considered when investment portfolio is being made. Okay, so first of all, whenever you are evaluating any instrument, okay, in terms of return potential is indicated by yield. Yield to maturity is generally the term that is being used. Yield to maturity, basically, if a bond has a yield of maturity of let's say 5%, okay, and it's going to mature after 2 years. So yield to maturity basically means if I hold that bond for next 2 years, okay, my annualized return would be 5%. Okay, so returns are logged if you are holding the instrument to maturity. Okay, so that's your yield and it's indicate return. Okay, but the thing is, if yield increases as the maturity period increases. Okay, so generally what happens, 1 year bond, the bond that is maturing in 1 year, okay, would have a lower yield than bond that is maturing in 5 years, and the 5-year bond in turn would have a lower yield than bond that is maturing in 10 years. Okay, generally it follows this upward curve. Okay, sometimes in very rare scenarios curve also gets inverted when we are looking at recession or economic downturn. The curve also gets inverted where higher yielding bonds, higher duration bonds are actually yielding less, and lower duration bonds are yielding higher returns. It's happening in US right now, where 2-year bonds with 2-year maturity are yielding around 5%, while bonds with 10-year maturity are yielding around 4%. But that's rare scenario when somebody is looking for when there is expectation that recession would come. Okay, so typically a general ground rule is higher duration is high yield, but higher duration also means higher risk. Okay, so let me explain the risk aspect. So let's say there is a bond that is going to mature in 5 years. Okay, you have bought the bond today. Okay, now and interest rates, repo rate is today 6.5%. Now over the next 1 year, let's say RBI increase the rate to 8.5%. Okay, so after 1 year, our bond maturity would be 4 years. Okay, but the new instruments that would be issued that would have maturity of 3 to 4%, they would be issued at higher interest rate. They would be offering coupon of interest of 8.5%, right? So what happens to our bond, our original investment? It start to go down. Its value start to go down. Start to incur losses. Okay, and it continue to go down till it is providing returns equivalent to new bonds that have been issued at higher interest. Okay, so whenever the bond is a 10-year bond is considered higher risk than 5-year bond is considered higher risk than 2-year bond. Okay, so you should never go for highest yield possible yield. You should look at when you need that cash. If you need cash after 3 months, go for 3-year bond that is maturing in 3 months, or instruments that have duration, which is measure of interest rate risk of 3 months. If you have cash flows which are maturing in 6 months, you should go for 6-month duration bonds. So that need to be considered. Never go for highest possible yield. First, think about the duration, then decide which instruments are providing the highest yield within that duration. Okay. Second aspect is credit risk. Okay. So this is always there. if a Reliance is issuing a bond, it would have a higher credit rating, let's say, than a Yes Bank. Okay. And so higher credit rating means there's a near zero probability. AAA rating, basically AAA rating means there is zero probability of issuer defaulting on payments. Okay. And as your credit rating goes down to AA, A minus, B, triple B, B, double B, C, and D, probability of default increases. And when probability of default increases, your expected returns also increase. So a company which is expected to return money, for sure, there is a 100% guarantee they will return the money. They will pay 7.5% interest rate, and the company where there is a nearly 40% probability of default, they would have to offer higher interest rate to attract them. Okay, 8.5 or 9. Okay, so again, you should not look for the yield part. First, make sure that the bond that the investment that you are making in mutual funds and the bonds that you are investing in, they are providing exposure to AAA rated debt. Okay, so there is credit default is out of question. So once AAA rated bonds are there, bonds are within your duration. Okay, within whenever you need payment is satisfying the duration risk condition, it has a higher credit rating, then you have a list and you can sort out the instruments that you want, and you can sort it out on basis of each. Okay, and then there's a third risk, which is liquidity risk. That is mostly in case of bonds. Okay, bond market in general is large segment of bond market is not liquid. Okay, and it's difficult to exit before the maturity. So if you want to exit, like I will give you one example. So one gold bond, you might have heard of SGBs. Okay, they provide almost equivalent to the gold equivalent exposure with additionally some interest on top of it. Okay, so most of the SGBs today sell if you want to sell them in secondary market. Okay, before maturity, because maturity is 8 years and you want to sell it before in the stock market. Okay, on the exchanges, you basically have to sell it at a discount of 3 to 4% to attract the market. Okay, so if some sections of bond market are not liquid, basically the higher known names like HDFC Bank, ICICI, SBI, their bonds would have larger demand. Okay, on the dealer desk. Okay, there would be more demand. Book building there would be many more participants in book building there. Okay, so it's easier to exit them. Okay, but if a NBFC is a small cap NBFC is issuing the bond, there's less interest there. There's a less demand for that bond, and there would be a liquidity premium that you need to pay if you want to sell it earlier. The good thing is that with regards to mutual fund, there is no such problem, because mutual funds redemption requests are honored by mutual fund companies. So there is definite liquidity is always there. Okay, so whenever you ask for redemption at any time, any point in time, you will get your money back without any haircuts there. Okay. So here I've just given an illustration. Okay, I just explained it, but there's a slide for that as well. So let's say Mr. A we have given example, Mr. A bought a Government of India bond. Okay, and it's worth 1 lakh rupees with a yield of 8%, and maturity is after 5 years. Okay, so here if Mr. A held the bond for 5 years, let's say that he's holding the bond for 5 years. Okay, he will pocket 8% annualized returns for 5-year holding period. Okay, this is fixed return in that case. Okay, but if you come to scenario 2, okay, let's say Mr. A has to sell the bonds after 2 years. Okay, let's say in general yields are same, RBI has not changed the rate, there is no expectation, it has remained same. Okay, so it basically Mr. A almost 8% return he would pocket 8% return. Okay, it will be nearby that. It may not be exactly it, but nearby that. Maybe 8.1, maybe 7.9, but it would be near that. Okay, there's a high probability he would get that return. But if RBI increase repo rate, okay, by 100 bips, let's say during these 2 years, then there is a very high probability that actual annualized return would be around 6.5 to 7% for 2-year holding period. Okay, because there would be instruments out there in the market which would be issued at those higher rates, higher interest rates. Okay, and those most of the investor money would go there. Okay, so to get so the value of bond will continue to go down in the market till returns are equivalent to new issues. Okay, but it can go other way as well. If RBI, let's say, reduce repo rate, then what would happen? That now this bond is providing higher interest rate. The new issuance would be at lower interest rate. So actually its demand would increase and its value would increase till the time bond yield become equivalent to new issuance. Okay, so it works both way, downside as well, upside as well. But as this is your treasury, short-term treasury, okay, this is needed for business. Okay, and there are estimations which are made on basis of that. Okay, availability of this money. Okay, so we typically treasury portfolios are designed with zero risk principle, where upside risk is completely ignored. Okay, and the focus is on neutralizing downside risk. Okay, and this what I'm talking about is duration risk, interest rate risk, basically interest rate risk or duration risk that we're talking about. So when you're building a portfolio, how to go about it? I've given just a illustration here. So let's say a company has received a cash flow of INR 1.15 crore, okay, and they're supposed to use that in next 3 months, okay. So they want 10 lakhs after 7 days, okay, 60 lakhs after 1 month, 35 next another 35 lakhs after 2, and 10 lakhs after 3 months. So basically, we have created this portfolio. Okay, the portfolio has been created keeping these cash outflow requirements in mind. Okay, so if you look at overnight fund, 10 lakhs that is needed within first 7 days. Okay, so that has been 10 lakhs have been allocated to overnight fund. Overnight fund is zero risk fund. There is zero probability. Whatever returns are there, you can expect to pocket them. Okay, with reasonable. I would say it's near 100% probability that you will pocket them. Anytime you want to sell it, you can sell it. Okay, even if you're selling after 1 day, you would pocket those returns, annualized returns of whatever has been promised. Okay, so 10 lakh have been put in overnight fund. Their duration is around a few days actually. Expense ratio is also quite low. Okay, considering in 7 days returns would be much less, holding period is less, so expense ratio is quite low. And there is no exit load after 1 even there is no exit load here. Okay, even if you sell it, put the sell order next day, there is no exit load. Okay, in case of overnight fund. And here basically treasury team has provided the instruction that withdrawal has to be happen after 7 days. Okay, then the liquid fund, there is allocation to liquid fund. Okay, liquid and arbitrage fund, 50 lakh in liquid fund, 35 lakhs in arbitrage fund. Here the duration is around 1 month. Okay, nearly 1 month. Okay, yields are also quite reasonable, 7 to 7.5. Okay, so this money would be needed within basically contribute to money that is be needed in after 1 month and 2 months. Okay, here exit load is also zero after, because the money is needed after 1 month. For liquid fund, exit load is zero after 7 days. For arbitrage fund, exit load is basically zero after 30 days. After 30 days, for most debt mutual funds, actually every debt mutual fund, exit load is zero. Okay, so here instructions are there that after 1 month, liquid fund would be withdrawn, and then how much would be withdrawn after 1 month. And based on these duration, returns, expense ratio, and exit load requirements on these parameters, we have basically then the remaining allocations in arbitrage fund and money market fund. Okay, so this is how the portfolio is created. That what is going to happen after next 3 months when you need money. According to money, you make sure that there is no liquidity is there is no zero duration risk, and then you think about the maximizing the returns. Okay, so here the proposed portfolio is supposed to provide returns of 7.3%. Okay, with zero penalty in terms of withdrawal schedule, and there is no near zero risk of principal loss. Okay, and the thing is, treasury team is also supposed to review the portfolio at regular interval for yield changes, for yield and duration changes for different funds. Typically, these instruments are used for creating the treasury portfolio. As you can see, we have started with the least risky, and then we went to most risky, which is equity fund. Equity funds typically are not recommended, okay, in treasury portfolio. So it's overnight fund, and overnight fund returns expectation has to be reasonable, 6 to 6.5 basically. Its return expectations have actually improved, and now last 1 month. Okay, risk is 0. Ideal investment horizon is if you want money within next 5-10 days. Okay, and loan against collateral, as I already mentioned, is available for all the funds. Liquid fund, if you're looking for nearly 1 month investment, and investment of 1 month, returns goes up to around 7 to 7.25. Okay, for ultra short term, basically ultra short term arbitrage fund is also for 1 month. Basically, returns are a tad bit higher at 7.5. One advantage with arbitrage fund is that taxation is at lower level. For all funds, you are taxed at marginal tax rate. In case of arbitrage fund, taxation is at around fixed rate of 15% for short-term gains. Okay, so there is one big advantage with the arbitrage fund. Ultra short-term fund, money market fund, they are usually suitable for three investments which are needed in next 3 to 4 months. Okay, and low duration funds and floating rate, returns are improving as you see, but ideal investment horizon is also improving because duration is also increasing as we go. Okay, then we have short term, and next is high credit corporate bonds, GSAC 5-year, 10-year returns goes up to 8.5. The highest returns are typically provided by low credit corporate bonds. Okay, so here they are also available for 12 months. Duration is also less, but due to high credit risk, high probability of default, interest rate goes up to around 11%. Okay, so these are the instruments that are typically considered in case of treasury, creating a portfolio for short-term treasury. Generally, low credit bonds and equity funds are avoided by treasury managers. Okay, so here the thing is, we have shown that short-term treasury can be deployed. We have also introduced basic concepts where we basically introduced the advantages of using a treasury portfolio. Okay, we have also provided some case studies, shown the delta, and also explained the basic concepts and the instruments that can be used. Okay, but usually, as happen in big corporates and big family offices as well, most of the time this treasury function is a dedicated function. Okay, the thing is it require deep analysis of cash flows. Okay, you need risk management, you need to take care of the cushions, okay, which has to be there. Okay, you need to select the right instruments, look at the yields that is there, what is the track record of managers in the past. Okay, what is the ideal fund that should be there. Some funds are different type of there, dividend paying, growth aspects is there, dividend is there. Growth aspect is typically better in terms of, growth versions are better in terms of tax efficiency. Okay, direct funds, then there are regular funds and direct funds are again better. Okay, because they cost much, almost half of regular funds. Typical regular fund typically goes to 100 or 150 basis point, while a direct fund costs 40 to 50 basis point. That make a big difference to the eventual returns that you are getting. Okay, apart from that, then portfolio management is needed. You need to review the portfolio on regular interval. Okay, let me give you an example. So let's say you make a portfolio for 6 months. Okay, so after 3 to 4 months, you are remaining, you will need the money basically after 2 months. When you need the money, your liquidity needs have changed. It's not 6 months, it's now 2 months when you are in the 4th month. So it makes sense for you to basically do some risk management and move a part of it in lower durations. Rotational basis, start moving into lower durations so that risk can be avoided. Okay, so this kind of regular portfolio adjustments are needed. Proper so trade execution, they take care of complete trade execution, reporting. These functions are taken care of. I already explained the function of duration matching. Okay, and it's also basically treasury is not a business function. It's a more of a investment function. Okay, so if you have dedicated treasury manager who is taking care of all the aspects, okay, they take management, CFOs, CEOs, they have basically more bandwidth to pursue more important, more critical growth functions. Okay, rather than finding out which investments are the best. for them. They're not spending their time. They can basically let treasury manager through all the legwork, present the findings, and give a final approval. Okay, that would be a much more efficient way of implementing this. But the problem is with the treasury function, it makes sense for to have a dedicated in-house treasury manager or in-house treasury desk. When you if you have let's say a treasury of around 100 crore, 150 crore, only then it will justify the returns. Okay, of having a treasury function in-house. So what are the solution for MSMEs having a short treasury of 10 crore, 20 crore, 50 crore, maybe up to 100 crore as well? Okay, so we suggest that for small treasury for MSMEs, which is typically associated with MSMEs, SEBI registered investment advisor might be a perfect fit. Okay, so if you see, it's a really cost effective. Okay, typically these RIAs charge nearly 50 basis point of the 50 basis point of the corpus. Okay, basically the additional delta that you're creating through treasury management, that is more than enough to justify their service and the cost that they're asking for. Okay, basically delta itself pay for it very well. Okay. The best thing is RIAs are not allowed any commission or kickbacks from any AMC or any mutual fund platform or any broker platform. Okay, any bond issuer, they cannot receive any commission and kickback. It's illegal in RIA regulations 2020 that were basically issued by SEBI. It's illegal to receive any commissions and kickbacks. Okay. So basically, RIAs recommend you direct funds. Okay, they are working for you. They have no advantage of recommending a particular fund. Okay, for if it is HDFC fund or ICICI fund or SBI fund, there is no advantage, any specific advantage of for that RIA to recommend any particular fund. Okay, they receive their money from you. They receive their fees from you. So it's their interest aligned with you. If you make money with their choice, if they've made a choice and it works for you, it works very well for them. It works very well for you. It makes money for you. That's where they will get more business, and that's the only way they can increase their revenue. Okay. As I already provided, they can already recommend direct fund. Delta is 50 to 100 basis point our regular fund, and it makes a lot of difference in the eventual corpus that you have. Right? The best thing with RIAs is that there is a comprehensive control on investment. There is total control, I would say. Okay, so advisors typically advise you a portfolio. They will create a portfolio for you. You will tell them, okay, this is the money I want to invest. This is when I need it. Okay, this is what these are my concerns that need to be addressed, and in line with that, they will make a portfolio for you. Okay, and but that would they will basically give that portfolio, transfer that portfolio to you. The portfolio would tell you how much to invest and where to invest. You need to give a approval, final approval. Okay, the client need to provide the final approval. Okay, on that. Without client approval, neither redemptions can take place, no buying can take place. Okay, and the money has to be transferred to mutual fund companies directly. Okay, RIA cannot receive money on behalf of mutual fund companies from a client. Okay, so there is a total transparency. Okay, there is apart from that, if you let's say want to remove, let's say your treasury has grown too big over the time, you've grown to over the next 5-10 years. Okay, you've grown too big and you feel that okay, you can manage yourself, you have a lot of experience now with the treasury, and now you know where to do, or you can also hire some person in-house. You can have an in-house treasury team. It makes sense now. Okay, so there is a no frills disassociation. Okay, there is no exit, there are no exit charges. Again, they are not allowed to charge any exit charges. Okay, RIAs. Okay, you have complete control on your investments. Even if you're taking, when you're taking RIA service, you have complete control on your investments. You can take independent buying and selling decisions as well, when as and when it is desired. Okay, so you will simply inform RIA that we do not need your service anymore. Okay, and settle the existing advisory charges and all, and you are free to pursue on yourself. They are not blocking anything. They are not blocking asset to your access to your investment. They are not holding any asset. Okay, So this is all about how Treasury can help in, basically Treasury Management can help in optimizing working capital, returns on working capital. Okay. This is all from our side. Thanks for your patience, and we are open to questions.
Thank you, Mr. Sharan, and thank you, Mr. Agarwal. And now we will start with our Q&A, and would request both of you to share your perspective on all the questions. So let's begin. My first question is, could you elaborate on the range of instruments and strategies available within treasury management? Which ones are particularly relevant to medium-sized businesses seeking to balance liquidity and returns?
Could you please come again? I missed the first part actually. Sorry.
Could you elaborate on the range of instruments and strategies available within treasury management, and which ones are particularly relevant to medium-sized businesses seeking to balance liquidity and returns?
Typically, all the mutual funds that have duration of up to 6 months are suitable investment options for deploying, basically for deployment to short-term treasury, overnight fund, liquid funds, arbitrage fund, ultra short-term funds, money market, even your short-term and floating. If you want to go up to 9 to 10 months, you're willing to go to 9 to 10 months, floating rate bonds and all. So these are actually decent investment. Thing is that you have to see when you need the cash flow and you match your duration. So let's say you need money after 6 months. Okay, let's say you need money after 6 months. You can deploy and you deploy money in overnight fund. Okay, so in case of overnight fund, yes, there is zero risk. There is zero liquidity risk there. The money is always available. There's no problem. But the returns are in a range of 6.5 to 7%. Okay. So if you know that you are going to need money after 6 months, okay, you can deploy it in money market fund where you can get returns of around 7.5%, 7.5%. So it's all about understanding the cash flows. So if your cash flows are up to 6 months, you need to consider funds that have duration within 6 months. Okay, and then you need to inside 6 months how your cash flows are stacked up, that decide the portfolio, and that there you can basically try to maximize while taking care of liquidity needs within that 6 months. So that's the first step is duration matching. The second step is your cash flow alignment, and then the third step is your return maximization.
Thank you, Mr. Agarwal. And Mr. Sharan, do you want to add something what Mr. Agarwal said?
No, I just want to add on to it is that yes, apart from the funds which are available, if you're looking from a short-term perspective, but if in case you're looking for more diversification perspective, then obviously we can look at other bonds which are available, the government bond which are available. But yes, the durations are higher over there. So from that perspective, we'll have to see. So again, looking at the requirement of the medium size, because it depends on industry to industry, what kind of a requirement you have, what kind of a plan you have, a cash flow, or it can be that you have built a reserve for 3 years or 5 years for your expansion. And a lot of mid-sized companies would like to do expansion, do some modernization, or they want to, in terms of the many things, machinery they want to automate, robotics they want to add. So obviously you need to, like when I was talking to one of my friends, I met in Delhi, he has his own factory, right? And they have been on the last 10 year per se, they have been continuously modernizing and improving the overall machinery. They have built robotics and how they have planned. So every 3 years they had a plan of action, and for those 3 years they were planning how much money is required. So again, I'm just giving an example on how multiple things. But yes, for short term, as what Karan said, all the debt fund which are available, right? But from a long term perspective, I think there are many more instruments available which we can be explored.
Agreed. Yeah.
Thank you. So my next question is, in the context of our business size, what are the key benefits of effective treasury management, and how can we use these strategies to enhance our financial stability and growth prospects?
See, if you look at the options out there, if you look at the working capital, the way that traditionally working capital is managed, so normally the working capital returns are stands at around 3.5% to 4.5%. Here you are looking at treasury through treasury management. If you look at take it to treasury portfolio, you are looking at 7 to 8% of returns. So you are getting an additional delta of 3%. Okay, and initial years I would agree that first 1 or 2 years. Okay, if you see that amount seems too small because mostly working capital is quite it's also quite unstable. You put you put 3 crore rupees, you need after 45 days 1 crore, you take out 1.5 crore, then you again take out 50 crore, then after, on fourth month you again put some 3 crore. Okay, so there is compounding aspect actually do not get triggered in next first 3, 4, 5, 6 months. But as you go into 2, 3 years, you will find that if you continue doing it for 2, 3 years, you will find that you would have sufficient excess cash that is there that can fund your working capital for 3 months to 4 months in case of any business emergencies. And actually it can be a source of fund, additional source of fund, or any inflation related adjustment that you need in your working capital. The additional compounding impact that start to kick in after 2 years, and initial 1 or 2 years, it take care of that inflation component as well.
Thank you, Mr. Rawal. And
Just want to add one thing.
Yeah, please.
Want to add a point over here. So see, just give a simple maths, right? If you have 1 crore and if you invest only over the weekends, nothing else, you invest on Friday and take out that money, 1 crore, you make almost 2 lakhs. You do nothing, right? You do nothing over there. So the point is, if you compare with all the big guys, right, who manage treasury, uh, obviously it, as the current said, it compounding effect helps in a bigger way. But there are a lot of other advantages which they a definitely it can help you in showing better, the metrics, be it for internal stakeholder or external stakeholders. Second, it helps in definitely if you are trying to raise debt, you show higher income, you can, a bit more high income, more stability. That also help you in getting better interest negotiation with your banks. It can also, once you increase the return, it will also help you in increasing your runway for, especially if I'm talking about the startups. Because if you don't manage it, like we all know, there's a funding winter kind of a thing situation going on. So definitely, if each and every money should be utilized well, and if properly done, it can help you increase your runway, which is very crucial at this point of time. We are witness of it, so definitely we can talk more about it. But yes, these are the more, which had other benefits from that perspective.
Thank you, Mr. Shil, and thank you, Mr. Rawal. My next question is, as an MSME, we often deal with fluctuations in cash flow. How can treasury management help us better manage our cash reserves, ensuring that we have the necessary funds for operational needs while also exploring investment opportunities?
See, thing is the main advantage, I would say, return is, yes, return is a one thing that people mostly look at, but I would say the main USP of treasury portfolio is the liquidity. Okay, so you are basically going for higher returns. Okay, you are going for 7 to 8%. There you are languishing at 4.5%, and then there are restrictions on withdrawal. Okay, against FD, if you withdraw, you pay penalty. Okay, or you would be relegated to a lower interest rate. Okay, even if you go for a overdraft, okay, you would pay some interest. Okay, and here you are getting additional returns, but their liquidity risk is zero. Okay, so if you most of the funds, almost every I would say every single debt fund, okay, has exit load after 1 month of holding. Exit load is zero for every bond fund. Okay, for overnight fund is there's no exit load at all. For liquid fund, it's around 7 days. After 7 days, exit load is zero. Okay, so liquidity is available to take care of your cash flow fluctuations. So you are going for higher returns while getting higher liquidity. Okay, so that's a win-win for entrepreneurs. Okay, that's basic, and just like having the cake and eating it too. And I think that's pretty much cover the point.
Thank you, Mr. Agarwal. Mr. Sharan, do you want to add something?
I'm good. I'm good.
Thank you. Then I move on to my next question. What are the potential risks associated with different treasury management strategies, and how can we mitigate them effectively? Are there any real life examples that highlight successful approaches for medium sized businesses?
See, thing is, one of the biggest risk that is with treasury management is, I would say, it's more of psychological aspect. Okay, so I can give an example. So like in 2020, interest rates came down significantly. RBI cut interest rates due to COVID. RBI cut down interest rates by around 250 basis points. 150 basis points in March. Before that, they were already cutting down. They were already on cutting speed. Okay, and bond funds give tremendous returns. Whenever interest rate goes down, interest rates go down. As I already explained, value of your existing holdings increase. Okay, because they are providing higher returns than new instruments. Okay, so returns were quite good, 10, 12, 13%. These are the numbers we are talking about in 2021. Okay, what happened now? The interest rates have gone down. Okay, banks are providing FD at 3.54%. Even longer term FD was around 4.5, 5-year FD. And even the new instruments that were coming in market, so let's say overnight fund was yielding around 5.5 to 6%. Okay, so now people got a lot of people in MSMEs, or people who had first time introduced to treasury in 1890. Okay, they basically got overconfident that when you invest in mutual funds, on debt mutual funds, you always make money, 8 to 10%. Okay, and then the people are also selling on ground. They also need to sell on ground. So it's very difficult to sell a product that is giving now 5.5% when you have seen 12% in last 1 year. Okay, so what happened? There was a law. So people basically went for in search of yield. Okay, 7%, 8%, so 6.5, 7%, 7.5%. Okay, these are the numbers people are looking for. So even if they need money after 3-4 months, okay, there were investments in 2-year bonds which are maturing after 2 years, 3 years, 4 years. Okay, and what happened suddenly? RBI started increasing rates, and 2022 has been terrible year for long-term bonds, specifically for 10-year, 5-year bonds. Okay, returns were around 2 to 3%. Okay, so thing is, the point is, you need to understand your requirement. You should never go after the returns. Returns are there. So you are already doing better than FD. Even if you go for one night fund, you will do better than FD. Okay, that's a given. Okay, that is a given. So the focus should be on risk. So you should first decide when you need the money. That should be your first reason point. Okay, so if you need money, let's say in 3 months and 6, let's say you need money within next 1 year. So you should focus on instruments which are providing, which have duration of up to 12 months. Okay, so if it is 6 months, okay, you should focus on instruments that have duration up to 6 months. Okay, and then after that, the return maximization activity can start without compromising on credit risk. The credit risk is one more risk that people add when they are going for highest returns. Definitely, a bond that is trading at that is a credit rating of BBB would easily provide return. Even today, they will provide return of 12%, 11-12%. That's very easily available in the market. Okay, so that's the main risk MSMEs take when the treasuries become overconfident and the returns become the target instead of a additional thing. It becomes the target. Okay, so that's pretty much.
So I just want to add one thing. So I come from NBFC in the past, where you have daily transactions, and where you have inflow outflow happening every day. Like many of the companies have fixed outflow, but inflow can happen every day or spontaneously. But one thing which is there in the current market, like there is no FD for less than 7 days. Okay. If you want to do an FD, you have to do minimum 7 days. That's the minimum by bank. Otherwise, you have to put in the current account. Right. So what these NBFCs used to do is, so as already explained, right, anything which is required for 7 days, 15 days and all, you have different instruments. But since you have, a daily cash flow happening, right, where you get money, you take out money, you get money, you take out money, that happens on a daily basis. For that scenario, most of the NBFCs, they put money in the overnight fund, where you get almost 5.5 to 6%, right? Because there is a zero risk, there is no FD comparison. Okay, so you only compare current account, which is 0% return, and at the same time you can liquidate, every day from that perspective. So what they used to do, like just giving example of such, organization where they have daily outflow happening, right? Is that whatever money you get, you first whatever money you need to, put in case you have surplus and you want to use that money for making any payment that day, you use that. But ideally, you should put every money in the overnight fund, and then next day whatever balance is there, you take out from there and keep on using it. So you get higher returns also at the zero risk perspective, and that's how most of the larger NBFCs and all banks also, for that matter, manage for that daily transactions for those kind of businesses. But if you have a dedicated outflow happening, which you know after 7 days, 15 days, you know that that's the duration, then obviously you need not put it overnight. You have better fund from that perspective and liquid funds and other things.
And there is one more aspect to risk management in general. So if you're, let's say, investing for 2 years, let's say you are investing some funds for longer duration, 18 months or 2 years, regular review is actually required for the portfolio. Okay, because for mutual funds, after 6 months, let's say you are holding a mutual fund for 6 months, duration practically remains same because new issuance keep becoming part of the fund. So after 6 months, you need to rotate slowly to lower duration funds. Okay, otherwise you are exposed to interest rate risk. So that is also one of the key component of treasury management.
Thank you, Mr. Agarwal and Mr. Sharan. And my next question is, in a rapidly changing economic landscape, how do you recommend staying updated on the latest trends and innovations in treasury management? And are there any industry best practices that we should be aware of?
See, there has been a lot of favorable changes that have actually happened in last few years. Okay, SEBI regularly release new regulations. They are basically open for public consumption. Most of the financial portals like Economic Times, Money Control, they always publish whatever has been released by SEBI. Okay, because mutual fund is one of the largest segment in Indian investment landscape. Okay, it accounts for nearly 60% of assets in fund structure. Okay, and impacted nearly 50% of investor base in India. Okay, so any changes to mutual fund regulations or any changes to fund landscape, regulatory landscape is actively covered. There have been recently some big changes. Okay, like direct funds have been introduced. Okay, and direct funds are it's mandatory for fund houses to release direct versions. Okay, offer direct versions. Okay, it's very easy today to execute. Okay, there are platforms which are available. Okay, which are facilitating execution, and there are proper safeguards that have been taken to ensure that execution is free from any basically investors are protected against any fraudulent transactions. Okay, and like one example that I given, the SEBI regulation for investment advisor. Okay, this directly goes in interest of the clients. Okay, so if you are not allowed any commission or any kickback from any mutual fund company or any platform or anyone, okay, so it basically solves the conflict of interest problem. Okay, it aligns you to customer, and most of the investment advisors are legally bound to offer direct funds, which are 100 basis points cheaper. Okay, There have been a lot of other regulations which are also in pipeline. Okay, uh, uh, you might see a sharp reduction in expense ratios across the board for mutual funds next few years.
Thank you,
So,
Mr.
so
Agarwal.
apart from regulatory changes, I just want to highlight on the tech side certain innovation which is happening largely globally, but I think for larger organizations, it's happening in India. Uh, like, for example, there are companies which have come up with ways in which you can help them with forecasting, making their cash flows. Right now, there's a tedious process of getting your data, analyzing that data, and building. Because one of the treasury comes, I think before you put your money, I think you need to do a lot of exercise before that. Right? You have to finalize you have to see every day what is your cash position, investment position. You have to plan what is your cash flow, what is the seasonality of your cash flow, and all those things. So obviously there is a way which people do right now, but it's a more a tedious way. So what has happened right now, also from a tech perspective, a lot of companies which are coming, which will help in understanding that people can take that advantage also of getting those, like large banks, large corporates use those softwares to actually, they link this with their CRA, they link with their accounting system, they link with their payment system, and then they try to understand what kind of cash flow is there, and on top of it, they work on it. Right? That heavily reduces and also is an independent thing. So you can actually make your decisions better. That is one. Second, there are other solutions also which are there, like you can track how your cash investment position are, or if you are doing across multiple products, right? That will help you in understanding how you should plan your day for that interview. Or treasury is not a one day in a month process; it's a everyday process, right? You need to keep on top of it all the time. So there are enough things which is happening for the bigger players. I think from the SME perspective, I think there are certain things happening globally. In India, it is slowly picking up that how you can actually utilize technology in understanding your data better, and based on that data, how you can. So definitely, that is one area which I'll suggest all SMEs, everyone, to actually look for such solutions which will help them in easing their whole uh, the background work required for effectively managing the treasury. Our treasury has multiple components, so we need to look at multiple layers where we can add value through using technology, and that's one of the things to look at.
Thank you, Mr. Shan. Thank you, Mr. Agarwal. My next question will be, considering the opportunities and complexities involved, how can MSMEs like ours embark on the journey of leveraging the opportunities presented by treasury management? And what initial steps should we take to implement effective strategies and instruments?
The first thing that anyone can do, they start using overnight fund. Okay, that's the first step. Okay, any money that people have in their bank account or current account, okay, they can do a KYC with any one mutual fund. Okay, and once the KYC is there, they can place order with all the mutual fund companies. Entire universe is open. There are a lot of platforms which are out there, okay, which are facilitating online execution. You can basically buy 10 12 you can buy funds from all the companies from a single platform. Reporting can be at a single place. Okay, so you basically do KYC with one of the anyone mutual fund company. Okay, and you get yourself onboarded on platform and start putting money in overnight fund as the first step. Okay, and gradually you should start looking at your cash flow and see if you can go for higher durations as well. Okay, so you can easily diversify into liquid fund for the funds that you are not needing in next 7 days, and then you can move out in line with your duration analysis. Where do you stand? You can gradually start moving out. Okay, the second option is for initial hand holding. Okay, for all the introduction to the funds, how to basically filter them, what are different aspects that need to be looked into. Okay, which is the portal that need to be selected. Okay, you can initially take service from a RIA. Okay, and start using a RIA, start learning that basically start getting comfortable with the basic aspects of treasury management. Okay, and this is the one way you can start. And when you are going for basically when you are going for treasury, you are initiating basically you are if you are looking at mutual funds, basically treasury portfolio, okay, and you're looking starting with it, always go for growth direct options. Okay, they are the cheapest one and most tax efficient.
Thank you, Mr. Gawal. Do you want to add something, Mr. Sharan, to it? Thank you. Then I'll jump into the next question. Can you share success stories or case studies of medium-sized businesses that have effectively utilized treasury management to achieve their financial goals, and what were the key takeaways from their experiences that we can apply to our own business?
Anshul, you would like to take it?
Yeah, sure. So I can tell you examples of. I come from microfinance industry, so I have seen how various companies work there. Not just talking about where I used to work, but that was a bigger company. But it was once used to be an SME, SME I say, not an SME. It was used to be an SME, and then it became large. But I have talked to various CFOs, various accounting finance teams across smaller microfinance and smaller microfinance companies who are just serving maybe 10,000 customers or maybe 25,000 or even a lakh customer. So there, I think people who had a proper treasury function or who were taking a treasury advisory, they did much better in terms of managing their CRAR ratios, which is mandatory from RBI perspective. They were able to raise debt from nationalized bank at a lower rate because they were able to generate extra that cushion. Because see, it's very important to understand. Yes, initially people may not think that other income is important, but actually other income becomes important during bad times. Like if you look at the microfinance, let's say I'm giving microfinance come from there, is that you have seasonality. Okay? It's not that always green all the 12 months. Generally, you will see that the first quarter is a bad month, then it increases, and the last quarter is always the greatest month for all the banks and NBFCs. Now, from that perspective, how do you manage it, right? Now, other part is even from where you should partner with one, but also in terms of utilize that money, right? So you need to see how you can, effectively manage the whole when you're getting the money, how you're utilizing it, that you don't keep the money in current account at any given point of time. They were utilizing it, as I said, smaller company, they were able to, because see, all these loans were given at 18 to 23%. And if you were, and if you put that money only in, say, for example, current account or just simply in a FD, you get much lower return. So they were trying to maximize that treasury in such a way that the carry what they have was minimal. When I say carry, obviously, it helps in managing the cash flows better. You have lesser cash to, on which is earning zero returns, and it will help you better. And when you go to any of these banks to get funds, or you're talking to investors from that perspective also, they will always appreciate that you are able to generate extra return by effectively managing your treasury. I'm just giving NBFC example, but if I talk to someone else, like I'm talking to an analytics company over here who is having a revenue of around 90 crores. So they were having a proper they were not having a proper treasury team, but they were taking advice from a particular investment advisory firm, where they helped them in managing the whole cash in a much better way. Before that, what they were doing was they were putting only in FD. Okay, they were not actually putting in anything else, either in FD, or they were because they didn't have, in most of these smaller companies will have bare bones accounting team, that's all, or a bare bones finance team. If you look at a finance team perspective, there are three main roles. Okay, the first is accounting, second is fundraising, and third is cash management. So obviously, cash management always the third in the priority, even for a CEO. Okay. So from that perspective, they built only a bare bones financing, right? As we explained also, when the treasury team is required. Before that doesn't make sense. So they employed, a proper treasury team who used to manage almost close to 30, 40 crore of cash for them from the overall reserves and everything. And that changed the term for them in terms of the margins, what they had. They improved significantly their margins. I think from almost less single digit margin, they became almost uh, the contribution of treasury was almost 2 to 3%. Obviously, they improved the margin because of other reasons also, but treasury helped them in improving the margin by 2 to 3%, became double digit. Second, it also they were able to raise debt. They were also able to raise equity because everything improved. Their runway increased, their cash, your margins improved, which they can further deploy multiple things. They were able to manage, they were able to generate cash reserves more, which was in line for the expansion, what they were trying to oversee the expansion. So that's all. So one is that is something that I talked about, which is into it was I think 90 or 80 crores of revenue. And then I talked about the various NBFC, smaller NBFC I'm talking about, which are not yet large, call having revenues of less than 50 crores or 70 crores kind of thing. Right. So that's my experience of it. Karan, you want to add anything?
No.
Thank you, Mr. Sharan. And my next question is, are there any regulatory or compliance considerations that MSMEs need to be aware of when implementing treasury management strategies, and how can we ensure that our approach aligns with the relevant guidelines and regulations?
Thing is, corporates are allowed to invest in mutual funds. Okay, there's no restriction as such from government or any regulatory body. But thing is, they have to comply with KYC regulations. Okay, and they need to provide relevant documents. Documentation is there. Okay, board approval is needed. Okay, board has to provide an approval that mutual fund investments are allowed, and companies allowed to pursue those investments. They basically specify in board resolutions is typically specified which instruments are allowed to be pursued. Okay, and then who is the people who are authorized to carry out these transactions or approve these transactions and make the payments. So, and in fact, I can tell you that regulations and these regulations are enforced both by advisor. If you hire an investment advisor, they will also enforce them. Okay, they will ask for all these documents. Okay, they will also abide by the board resolutions. Okay, apart from that, a risk assessment is also done. We have to also, advisors also have to abide by risk assessment when they're advising. Okay, because that is in line with SEBI regulations. So if it is not being abided, if you are not abiding by them, you are violating the SEBI regulations. If you are going, let's say you are going directly, even if you are going directly, mutual fund companies and platforms, they also enforce these regulations. They do not go for risk assessment, but board resolutions confirming who is the authorized person to carry out the transaction, which are the instruments which are allowed there in the board resolution. They also enforce from their side.
Thank you, Mr. Agarwal. Mr. Sharan, do you want to add something?
The other thing, I think, basic thing, but whatever treasury we do, it's all through company's bank account only. You have to have proper bank account where you have this cash and it has to be available. Okay, so that is very critical. Be it any investment you want to do, be it on the mutual fund side, be it on the bond side, be it on high risk bond side, or be it on equity. In case someone like big companies have that portion. But yeah, largely those are things. Otherwise, from SEBI or anyone else, there is no other regulation is required. The only advantage, one more thing I'll say is that if you do a KYC, as Karan mentioned earlier, you are free to do. You need not do KYC each and every mutual fund, each and every bond holder. You need not do. You need to do once. It's a one-time activity, which takes maximum 1 week, maximum if you give proper documents. It's a maximum 1 week process. It can happen in 2 days also, but I'm assuming they will be back and forth. So maximum turnaround time is 7 days for doing that, and that's it. Then you are free to do, anything and everything. So it's that one. Apart from that, there's nothing specific which is required from a regulatory perspective.
Thank you, Mr. Sharan. My last question would be, what advice would you offer to medium-sized businesses owners like we who are eager to enhance our financial decision making through effective treasury management? And are there any common pitfalls to avoid?
Thank you, sir.
See, thing is, as I already mentioned, you should start. Basically, you should start making additional money. There is a easy money which is available. I would say, okay, overnight fund, name of overnight fund. Okay, you should start going for that. This will give you 200, 300 bips additional on whatever you are making on your treasury as of now. Okay, and it's totally risk free. Okay, go for direct growth versions. You can go to any mutual fund platform, do your KYC, take the position there. You can select the funds. There are around 30 companies which are off. I would not say 30, around 25 companies which are offering overnight fund. You can look at that. You can select which was best suitable in terms of expense ratio and returns. Okay, but and initially I would simply say that front initially the returns that you are making or the delta you would be making might not look significant. Okay, might not look significant. Okay, but if you are let's say you start doing it after let's say doing it for 2 to 3 years, compounding impact start to kick in, and it will provide a significant working capital cushion to you in case of emergencies or any inflationary inflationary phases. Okay, you would be surprised to know that most these big companies, NBFCs that Anshul is talking about, and other, they have they rely a lot on their treasury. Okay, their income from their treasury to boost their working capital, provide them with additional funds. Okay, they basically factor in that they will make 7 to 8% additional on their working capital. Okay, that will allow them to pursue some growth opportunities. It becomes that big after a point.
Thank you, Mr. Agarwal. Mr. Sharan, do you want to add something lastly?
I have only 2 points to say. The first point is those for treasury don't chase just return. I think it's important that you look at your cash flow and then decide what product to be choosing. Because in the garb of returns, a lot of people will come and tell you that I can give you XYZ returns, maybe in 12 months or 18 months or whatever the tenure is. But the reality is you will need money not for 12, 18 months. Most of the time you will need money a shorter term, and that's the time when you will not get the desired return, which no one, because they will try to sell you this something you'll get a good return, but that will help. So the starting point cannot be return. The starting point has to be your requirement, and based on that requirement, look at what kind of product you want to get into, what the debt fund or bonds, or even for if you want to get into FD. The other thing I want to say is, which we were discussing just before the call, also me and Karan, like one of the companies we were discussing is again sweeping FDs, right? So sweeping sweep out FDs. A lot of people come with this thing that you can get very good return in that. But I think the catch over there is that if you don't maintain the balance, then obviously the next it reduces your overall returns, right? Which no one will go and tell you about. Okay, no one talk about it because obviously it doesn't help them. So definitely from that perspective, I'm not saying it's a bad option, but can you maintain that? That's a choice you should have, and that should be realistically chosen. That what balance you can maintain, and based on that, you see what returns you can get, and obviously, based on that, then you can evaluate what returns you have with other options available, right? And keeping that in mind, one should look at the products you want to offer, be it debt fund, be it bonds, anything. Last piece, please don't invest in one particular kind of product. Like I just want to invest in FT, or I just want to invest in the liquid fund, or I just want to invest in the government one. No, you should definitely look at diversification. Diversification is the key. It's not that the big companies cannot just put in one particular asset class. They can, but diversification definitely helps because each and every product has those merits, and it works well in different scenarios. So the portfolio has to be built from that perspective that which has a better risk return trade off from the requirement of the company. Okay, so these are 3 pointers which I want to leave at the table. Uh, that's all.
Thank
Any
you.
other questions? Yeah.
Thank you, Mr. Sharan and Mr. Agarwal, for answering my all questions so efficiently. And I would like to thank all the participants and our audience for being there with us with this knowledge sharing webinar, and special thanks to both of you for giving us time. And with this, we come to an end for today's webinar. And once again, I would like to thank you all from the entire GCPID team. Thank you so much.
Okay.
Thank you.
Thanks a lot. Thanks a
Thanks a
lot.
lot.